I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi there, I'm JB. In this video, I'll take a look at Tesla. Oh yeah, Tesla my Esla, as Jeremy from Financial Education would say. Tesla is the largest position in all my portfolios combined, so this is just a small valuation video, not one of the large ones. In here, I just go through the fundamentals, the metrics, the numbers. This video is numbers only. I have made a few videos on Tesla and my long-term thesis hasn't changed at all. I will of course update my long valuation video soon, but my price prediction for 2030 is still at least $1,500 per share. Yes, you heard right, $1,500 per share. And that's with only around 15 million cars sold. But you'll have to wait for that video to get the details. And hey, that's a great reason to subscribe to the channel, so you don't miss out. Well, back to this valuation video. I use this valuation sheet to determine if a company meets my requirements for investing, and the sheet is the first gate in becoming a part of my portfolio. But as you might know, I have been invested in Tesla since 2016? I have dug deep in Tesla and the manufacturing process and everything else, cash flows, the innovative nature of Tesla, and I have never found a company like Tesla, or maybe it's because of Elon Musk. It's no joke when people say he plays 4D chess when everyone else plays checkers. Just look at the supercharger network. Elon started this back in 2012, and for a long time, no one really understood why would Tesla do that? Why would they invest heavily in that type of infrastructure? There's almost no EVs. Why are they doing that? Then around 17, 18, people started to understand it a bit when Tesla launched the Model 3, but they still just saw it as an added bonus to Tesla owners. Now the majority is beginning to understand what does it mean to have almost a monopoly on the future of charging. Imagine someone owned the majority of all gas stations, And yes, I know a few others try to make their own chargers, but let's be honest, none of them really truly committed. They're only doing it for the marketing value or the IRA credits. Their chargers don't even work most of the time. It was the same with FSD, full self-driving. No one understood why would Tesla put an expensive computer in every car? How stupid is that? Now most people understand that the data advantage gained over time is worth a lot more, and the ability to ask the network to provide specific situations from every car on the network, even if the car doesn't use FSD, using so-called shadow mode, it's the same that Waymo and others are paying millions for. And that's the story about almost everything Tesla does. The only manufacturer that really innovates and does as much as they can themselves, giving Tesla the vertical integration others can only dream about. Well, let's get into it. Revenue and earnings growth. As I mentioned in the last video, the process is going through the financials yourself is a lot better than just picking up the numbers. Of course, you could just look at sites like Guru Focus and someone like that. They serve up the data already processed and put into metrics. But you don't get the reason why the numbers are what they are and what the underlying information is. When I look at Tesla, I see an incredible growth story and it's accelerating. And that micro recession we're going to have probably in Q3, Q4 will stifle Tesla a bit more on margins, but hey, that's what I call a buying opportunity. So let's go through the individual points, and if you want a deeper explanation, look at the video about the metrics. Revenue. When looking at the last 5 years' revenue, we see an impressive average growth rate, almost 50%. That's not something you usually see over a 5-year period. And I bet this will accelerate and become 60 to 70% average growth rate in the next 5 years' revenue. Remember, the energy business is growing faster than the car business, and it's just beginning to show some real numbers. Operating income and growth. Well, that's a number you won't even believe. Almost 700%. That's crazy, man. But of course, that's because we're dealing with a company that's going from being not profitable to being profitable. And as we can see, it's the 2020 numbers where we're going from negative operating income to a almost 2 billion positive operating income. Net income earnings. The money is really coming in now with a 214% average growth rate. And I believe this will get a lot better in 2024, when both Berlin and Austin are ramped and Shanghai has expanded too. And the next big jump will be in 2026, when the next gen vehicle is ramping in Mexico and maybe even Shanghai, and maybe even beginning in India. We don't know yet. A $25,000 car with a margin of at least 15, sold in high volumes, that's going to be huge. And by then, the energy business with Megapacks will probably have tripled. Remember, the Megapack factories are a lot simpler to build, and Tesla has orders for around next 4 years already booked, so demand is almost infinite. EBITDA, earnings before interest, taxes, and amortizations, or as Charlie Munger calls it, bullshit earnings. Here we see almost 400% average growth. That's completely bonkers. Even if we remove the 2018 number that's responsible for the highest growth rate, then the average growth from 2019 to 2023 is still 84% a year. Nice. Earnings per share. Well, Tesla went from a negative $0.33 per share to $3.62 per share. And when we look at the EPS over time, we can really see how Tesla is growing and is earning their money. 2023 is expected to be a bit over $4 per share, giving us an average growth rate of 174%. Free cash flow. The 5-year average growth is so crazy that I have to remove the 2019 number, and we still have 100% average growth rate. But let's see what end of 2023 brings. I still think we have a fairly bad Q3, Q4, but again, 2024 will be a lot better. And I'm not thinking FSD, Robotaxi, or Tesla Bot yet. They're just the extra bonus for 2025 or 2026, and maybe 2030 for Tesla Bot. I urge you to see the movie I, Robot, and Tesla will be the biggest company on Earth by then, looking just like the company that built the robot. At least, that is if the government doesn't split it up before then. So, to recap the revenue and earnings score in my valuation, it's a 100% rating. That's really rare. Let's go to the financial strength part. Cash to debt ratio. How long will it take to pay off debt using cash flow? Tesla is at a 397, which is pretty good. Usually, if cash to debt ratio is greater than 1, the company can pay off its debt using the cash in hand. If it's smaller than 1, it means the company has more debt than cash. Equity to asset ratio. How much equity does a company have in relation to its assets? Meaning, how much of a company's assets have been generated using equity rather than taken on debt. Tesla is at a 0.56 or 56%, which is quite okay. It's about the same as Nvidia. None of the OEMs are that good. Ford is at 0.16, GM is at 0.26. Debt to equity. Debt to equity means the financial leverage a company has. A high debt to equity ratio generally means that a company has been too aggressive in financing its own growth using debt. Tesla has a debt to equity ratio of 0.11 or 11%, which is great. Ford is around 3.32, GM is 1.65. Ooh, horrible. The current ratio. It's a liquidity ratio that measures a company's ability to pay its short-term obligations. It's called current because it uses the company's current assets to pay off current liabilities. Tesla's current ratio right now is 1.59, which is quite good. A ratio under 1 indicates that a company's debt due in 1 year or less are greater than its assets or cash. The higher the current ratio is, the more capable the company is of paying its obligations. The quick ratio. It measures a company's ability, again, to pay its current liabilities without needing to sell any inventory or use financing. The quick ratio is a bit more conservative than the current ratio, as it includes all the current assets as coverage for current liabilities. A low or decreasing quick ratio usually means that a company is over-leveraged, struggling to maintain or grow sales. The higher the quick ratio, the better the company's liquidity position. Tesla's quick ratio is at 1.07 and quite stable at this point. Cash ratio. The cash ratio measures a company's ability to meet short-term obligation with cash or near cash resources. The cash ratio is more conservative than the other liquidity ratios, such as quick and current, because it only considers the company's most liquid resources. Tesla is at 0.82, and for reference, that's twice as good as Ford or GM. Debt to EBITDA. It's a ratio measuring the amount of income generated to pay down debt before covering interest, taxes, depreciation, and amortization expenses. A ratio exceeding 4 is usually considered bad unless tangible assets cover that debt. Tesla's debt to EBITDA is around 0.33, again, compared to Ford's scary 7.89 and GM's 4.77. Tesla is doing great. Interest coverage. It's a ratio that determines how easy a company can pay interest expenses on outstanding debt. Ben Graham required a minimum of 5, and if the interest coverage is less than 2, the company is heavy burdened by debt. Tesla, it has a whopping 88.71, which is almost unprecedented. Ford is around 1.73, GM is around 1.52. And actually, Tesla is ranked better than 90% of companies in manufacturing too, and their industry median is 7.79. The Piotrowski F-score. If you want the explanation of this, see my video on the metrics. Here I'll just recap what values are good or bad. A good score is 7 or above, a bad score is 3 and below. Tesla is at a 7, which is good, and following the rule of Piotrowski, it's okay to invest in Tesla. The Altman Z-score. It's used to determine if a company is on its way to bankruptcy, and the score can forecast that around 2 years in advance. A score below 1.8 is bad. A score from 1.8 to 3 is called the gray zone, and everything over 3 is a safe zone. Tesla is at 14.88 in its Altman Z-score, so totally safe. By the way, Ford is 1.18 and GM is 1.26. Both below 1.8. That's bad. The Beneish M-score. The Beneish score is used to identify whether a company is manipulating its earnings or not. A score less than minus 1.78 suggests that the company is not manipulating. A score greater than minus 1.78, the company is likely to manipulate earnings. Tesla's score is minus 175, so they're just on the border, not likely manipulating their earnings, but they are awfully close to that border. WACC versus ROIC. Weighted average cost of capital. It tells us how much interest we should expect the company to pay for every dollar it finances. ROIC, return on invested capital, measures how well a company generates cash flow relative to the capital it has invested in this business. So, comparing WACC versus ROIC shows us if the company is creating value or destroying value. Tesla's WACC is 19.23%. The return on invested capital is 24.60%, so very good. And that's even with Tesla ramping a lot of factories. So, to recap, Tesla's financial strength score in my valuation sheet is 100%. Amazing! Let's jump to the profitability and growth part before we get into the valuation part. Gross margin and 5-year growth. Well, gross margin is at 25.6, which is very good for a car company and even a manufacturing company. If we look at the 5-year growth, we see a measly 7% average growth, but to be frank, that's to be expected when you start at 19%. Operating margin and 5-year growth. Here I would like to see some nice numbers, and Tesla doesn't disappoint.
Yeah, baby, yeah!
With operating margin around almost 17% and the 5-year growth of 531%, that's great. Even if we remove the 2020 number, which is crazy, we would still be at a 75% average growth rate. Net margin and 5-year growth. Tesla had around 15.45% for 2022, and the 5-year average growth rate is an amazing 136%. I'm happy as long as we're above 15%. Return on equity. Return on equity tells us how efficiently the company generates its profits. The higher the ROE, the better the company is at converting its equity financing into profits. ROA, return on assets. ROA measures how efficiently a company generates profits from shareholders' equity plus liabilities. Tesla's is at 12.19%. Just for reference, Ford is at 1.63 and GM is 3.89. Oh my god. Return on investment. What are we expected to get out of our investment in this company? For instance, the S&P 500 has historically returned around 10% in average. I expect at least 12% out of my investments. Right now, Tesla is at a 32%, which is great. ROIC, return on invested capital. It tells us how well a company generates cash flow relative to the capital it has invested. If you remember it from the WACC versus ROIC, Tesla's return on invested capital is 24.60%. Ford is 5.41, GM is 4.57. Return on capital, Joel Greenblatt style. Again, see my video on the metrics for an in-depth explanation. Here I'll just mention that his way of defining return on capital is more accurate. A high double-digit figure means that the company has a good edge, a strong brand, unique products, a moat.
You're gonna need a bigger boat.
Tesla is around 29.76, and compared to Ford's 13 and GM's 14%, Tesla is doing great again. ROCE, return on capital employed. Unlike its return on equity, which indicates the profitability of shareholders' equity, ROCE also considers long-term debt in capital employed. Tesla has 19.38%. Generally speaking, the higher the ROCE, the better. So recapping the profitability and growth score, we end up with an amazing almost 92%. Now to the real interesting part. What is the intrinsic value of Tesla, and what do I consider being a fair price for a share of Tesla? Here I should mention that it's really hard to guess the future growth rate, so we need to make some assumptions here. I have already done intensive analysis of Tesla and the possible future value, so for this one I'll try to use very conservative assumptions in growth for the value. Let's start from the top. Price to sales ratio. It compares a company's stock price to its revenue. With a price to sales ratio of 9.29, Tesla is far higher than any others, and that's not really a good thing. Price to book compares the share price to the company's book value per share. Price to book is 15.49 and significant higher than other automakers, but if we compare to tech companies, we're perfectly aligned. Adobe is at a 16, Microsoft is at a 12, and I consider Tesla to be somewhat a tech company. Enterprise value to EBITDA. This attempts to value a company, and it's supposed to be a little better than using PE ratio. Usually, you would like to see an enterprise value to EBITDA below 10. To comparison, the industry median is 9.41. And again, I would argue Tesla is closer to a tech company than an automaker. The PEG ratio, its price to earnings ratio divided by the EBITDA growth rate, it's considered an easy way to compare companies with different growth rates. Unfortunately, Tesla is growing way too fast, way too much, and the PE ratio is way too high, so we cannot really calculate a good PEG ratio. Earnings per share and the 5-year average. Well, earnings per share divided by 5-year average, I use that to see where are we going. and I need it for the EPS valuation too. Tesla is at a 74%, which is very good. And now we come to the pricing of what is a share worth. What do I consider a Tesla share could be worth? And remember, here we use a lot of different valuations. Some will be extremely low and some will be very high. But the reason I use them is because I combine them to get a reasonable conservative score that I think is possible and it's more likely to be correct. Book value per share is a very conservative value. It's shareholder equity divided by shares outstanding. Tesla is at a $16.13. In those high growth companies, we could compensate with a factor matching the growth rate, but instead I use the normal rate, giving me an extra margin of safety. Then we come to the EPS valuation. This is a standard discounted cash flow valuation where I use earnings per share to determine the intrinsic value. As I mentioned, it's extremely hard to predict growth, and especially over a 10-year period with ups and downs. Here I use a very low 30% growth for the first 5 years, 20% growth for the next 5 years. My minimum rate of return is 10%. Maybe it should be 12, but I'm using 10. Then I discount it back with that, and I expect the price multiple, the PE, to be around 40. That gives us a share price today of around $695. And as I said, that's probably too high, and I should maybe use the 12% discount rate and the 35 PE, and maybe even factor in that the EPS for 2023 will be lower than the $4 per share. But when we combine these prices, you will see that it actually makes sense in the end. Discounted cash flow valuation. In this one, I use the free cash flow per share, and I use the same assumptions as before. So 30% growth rate first 5 years, 25% next 5, 10% discount rate, and a multiple of 40. And in this valuation, it gives us a share price of around $333. The Graham number. Even though this will give us a very low valuation, I use a slightly modified version, and I know my version will give me a higher price, which is still very low. Usually the Graham number does not work when a company's PE is higher than 15, but still my modified version works. This gives us a share price of around $48. Ideally, I would multiply that with 5, but I'm just keeping the low numbers to keep us grounded because I know that my EPS valuation is going to be high. Peter Lynch fair value. Peter Lynch's fair value applies to growing companies that grow around 10 to 20% a year, so not really applicable here. But still, I use it, I have it, and I modify it a little bit to get a more realistic price. And with that, I get a price of around $181 per share. So, adding up all those valuations and finding the average, we get an average share price of $254.90. And that's a quite credible price in my opinion. As I used both low and high valuations, we don't really need to add a margin of safety. But just to be on the safe side, I will add a 10% margin of safety. This gives us a buy price for Tesla for just around $228, $230 range. And looking at the curve, we can see that that price was possible in a long period. And I'm guessing we're going down to those levels again in Q3 or Q4. If we don't use the margin of safety, as it's already built in, we could argue that the price around $253, $254 is an okay price. So this could very well be the correct value right now, especially seeing the numbers going lower and lower in Q3 and possible Q4. But just you wait until 2024 comes around. We are going to see some crazy numbers, especially when the Highland version gets released and the energy business is ramped. So buckle up, it's going to be a wild ride. I didn't go into the last part of my valuation. Tesla does not pay dividends, but they will start buybacks maybe in 2024, 2025. That's my guess. As you probably know, Tesla is my largest position across all my portfolios. and I buy more shares whenever I can. Though right now I'm accumulating cash and waiting for Q3. I believe the market does not understand that Tesla will have to pause production, have to retool and become more profitable in 2024. It's just like a race car that has to go into the pits and get new tires and filled up with gas. And now it's ready for a bunch of good laps. Same here. We need to get the factories done for the new model and ramped next year. Well, I hope you got some value from this video, and if you did, please hit the like button and maybe even subscribe so you don't miss out in future videos. If you have a company you'd like me to look into next, write the ticker in the comments, and if enough people ask for the same, I'll consider looking into it. That's all, folks. Hope to see you in the next video, and remember, the best investment you can make is in you. The more you learn, the more you earn. Bye!
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting. Living